What if everything you thought you knew about financial safety was about to be shattered? Imagine waking up to find not just the stock market in freefall, but your home's value plummeting and even government bonds, once considered the ultimate safe haven, crashing at the same time. That's not a distant nightmare. It's the scenario financial historians are now calling the everything bubble, and 2025 is the year it's set to burst. But here's the twist. This isn't just another market cycle or a repeat of 2008. The warning signs are everywhere. But this time, the very tools that saved us in past crises, slashing interest rates, printing money, government bailouts, are either broken or dangerously overused. The Federal Reserve can't cut rates to zero because inflation is still lurking. The government can't bail everyone out because it's already drowning in $36 trillion of debt. And after years of easy money, the safety nets we once relied on are threadbare. So, what happens when all three pillars of the financial system, stocks, real estate, and bonds, start collapsing together? The answer isn't just a recession. It's a wealth destruction event on a scale the world has never seen, one that could erase decades of savings, upend retirements, and reshape the global economy for a generation. If you think this sounds like fear-mongering, look closer. Every major financial indicator is flashing red, and the timeline for disaster is narrowing. The question isn't if the crash is coming, it's whether you'll be ready when it hits. To understand why 2025 stands apart from every financial crisis in history, you have to see the bigger picture, one that's never existed before. In the past, America has weathered devastating crashes, but each time the storm was isolated to a single sector. In 1929, it was stocks. In 2008, it was housing. But now, for the first time ever, we're facing a triple threat. Stocks, real estate, and bonds are all in simultaneous bubbles, each one stretched to extremes that defy logic and history. Financial historians aren't just sounding the alarm. They're calling this the everything bubble, a term that barely captures the scale of what's unfolding. The numbers are staggering. The S&P 500, the backbone of the American stock market, is trading at a price-to-earnings ratio nearly double its historical average. Home prices are 50% above their long-term trend, a level of overvaluation that dwarfs the 2008 housing bubble. And the bond market, once the last refuge for cautious investors, is buckling under the weight of $36 trillion in federal debt, with interest payments now outpacing even defense spending. What makes this moment so dangerous isn't just the size of each bubble. It's the way they're all connected. In previous crashes, when one asset class collapsed, investors could run to another for safety. When stocks crashed in 1929, bonds held steady. When housing imploded in 2008, the government could borrow and spend to cushion the blow. But in 2025, there's nowhere to hide. Stocks, real estate, and bonds are all teetering on the edge, and the usual escape routes have been blocked. The Federal Reserve can't slash interest rates to zero without reigniting inflation. The government can't borrow trillions more without risking a debt spiral that could destroy the dollar's value. And the safety nets that once protected ordinary Americans, like FDIC insurance and government bailouts, are stretched thinner than ever before. This isn't just theory. The warning signs are everywhere, and they're getting harder to ignore. Financial analysts are openly comparing today's market to the months before the Great Depression, but with a crucial difference. The tools that saved us in the past have already been used up. The Fed's balance sheet is bloated from years of money printing. Interest rates, though higher than a year ago, are still historically low, leaving little room to maneuver. And the government's debt load is so massive that even a small increase in interest rates sends shockwaves through the entire system. Meanwhile, the public is more exposed than ever. In 1929, only a small fraction of Americans owned stocks. Today, more than half the country's retirement savings are tied to the market, and millions have their wealth locked up in homes that could lose value overnight. But perhaps the most chilling aspect of the triple bubble is how quickly it could all unravel. In a world where everything is connected, a shock in one market can trigger a cascade of failures across the entire financial system. A sudden drop in tech stocks could spark panic selling, which then spills over into real estate as investors scramble for liquidity. Falling home prices could trigger defaults, putting pressure on banks already weakened by bad loans. And as the government tries to respond, the bond market could revolt, sending interest rates soaring and making the debt even more unmanageable. It's a feedback loop with no easy exit, and the consequences could be more severe than anything we've seen before. So why is 2025 unprecedented? Because never before have all the pillars of the financial system been this fragile, this overvalued, and this interconnected. The triple bubble isn't just a headline, it's a ticking time bomb, and the clock is running out. But the story doesn't end here. The next piece of the puzzle is the stock market itself, where a handful of companies now hold the fate of the entire economy in their hands. And what's happening there is even more alarming. If you want to see just how fragile the financial system has become, look no further than the stock market itself. On the surface, the numbers look impressive: record highs, trillion-dollar companies, and endless headlines about the unstoppable rise of technology. But beneath that glossy exterior lies a dangerous concentration of risk that's unlike anything we've seen before. In 2025, the fate of the entire market rests on the shoulders of just 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. Together, these so-called Magnificent Seven now make up nearly 30% of the S&P 500's total market value. That means if even one of these giants stumbles, the shockwaves will ripple through every retirement account, pension fund, and investment portfolio in America. This level of concentration is unprecedented in modern history. In 1929, a handful of industrial stocks propped up the market before the crash, but even then, the dominance wasn't as extreme as it is today. In 2000, the dot-com bubble was driven by tech stocks, but their share of the overall market was much smaller. Now the entire market is balanced on a knife's edge with a few companies holding up the rest. Nvidia alone, riding the wave of artificial intelligence hype, trades at a price-to-earnings ratio above 65, meaning investors are paying $65 for every $1 of profit. Its total market value has soared past $3 trillion, making it worth more than the entire German stock market. This isn't rational investing. It's pure speculation fueled by the belief that AI will transform everything overnight. But history shows that when expectations run this hot, reality almost always disappoints. The risks don't stop with sky-high valuations. Insiders, the people who know their companies best, are quietly heading for the exits. Reports claim that executives at Nvidia, Amazon, and Meta have been selling billions of dollars worth of their own stock, even as prices hit new highs. Jeff Bezos has unloaded over $13 billion in Amazon shares, while Mark Zuckerberg has cashed out billions from Meta. When the people running these companies start selling, it's a signal that they don't believe the hype can last forever. And it's not just tech insiders who are getting nervous. Warren Buffett, the most respected investor of all time, is hoarding cash at levels never seen before. Berkshire Hathaway's cash pile now exceeds $325 billion, and Buffett has been quietly reducing his stake in Apple, one of his biggest holdings. His favorite market indicator, the ratio of total stock market value to GDP, now sits at 185%, far above the level he once called dangerously overvalued. When Buffett is sitting on the sidelines, it's a warning that even the best see trouble ahead. But the real danger comes from how quickly things can unravel. With so much market value concentrated in so few stocks, a single earnings miss or a shift in sentiment can trigger a chain reaction. If Nvidia's next quarterly report disappoints, or if AI hype starts to fade, the stock could drop 50% or more in a matter of weeks. Because Nvidia alone accounts for 7% of the S&P 500, that kind of decline would drag the entire index down with it. And it wouldn't stop there. Algorithmic trading systems, programmed to sell when prices fall, would kick in, accelerating the decline. Other tech giants would get caught in the downdraft, and before long, the entire market could be in freefall. This isn't just a theoretical risk. The warning signs are already flashing. Insider selling is at levels that have historically preceded major market declines. Retail investors, lured in by stories of overnight riches, are piling into risky options trades and using borrowed money to chase the next big thing. Margin debt as a percentage of market value is back to levels last seen before the Great Depression. The leverage in the system is everywhere, hidden in derivatives, options, and corporate debt structures that most people don't even realize exist. If the market starts to fall, margin calls will force investors to sell, creating a vicious cycle of forced liquidation that can turn a correction into a crash almost overnight. And here's the most unsettling part. There's no easy way out. In the past, when one sector of the market got overheated, investors could rotate into safer areas. But with so much value concentrated in just a handful of stocks, there's nowhere to hide. If the Magnificent Seven go down, they take the whole market with them. Pension funds, retirement accounts, and institutional investors are all exposed, whether they realize it or not. The dominoes are lined up, and all it takes is a single push to set off a cascade that could wipe out trillions in wealth. So, while the headlines celebrate record highs and trillion-dollar valuations, the reality is far more precarious. The stock market's dangerous concentration has created a powder keg, and the fuse is already burning. But the stock market is only one piece of the puzzle. The next bubble, real estate, may be even bigger, and its collapse could send shockwaves through every corner of the economy. If you think the stock market looks risky, just wait until you see what's happening in real estate. Most people still believe that housing is the safest investment you can make, a bedrock of wealth that always bounces back. But in 2025, that belief is about to be shattered. The numbers don't lie. Home prices are now sitting roughly 50% above their long-term historical trend when compared to income and rent. To put that in perspective, at the peak of the 2008 housing bubble, the one that nearly destroyed the global financial system, homes were only 35% above trend. That means today's bubble is 43% larger than the one that triggered the Great Recession. Let that sink in. The crisis that required trillions in bailouts and left millions of Americans underwater on their mortgages was driven by a bubble that's now dwarfed by what we're seeing today. And yet, because prices have been high for so long, most people don't even realize we're in a bubble. It just feels normal, until it doesn't. But residential real estate is only half the story. The real ticking time bomb is commercial real estate, where the cracks are already starting to show. Office buildings across America are sitting empty, with vacancy rates in some cities reaching levels that would have been unthinkable just a few years ago. In San Francisco, for example, more than a third of all office space is vacant. The shift to remote work isn't a temporary blip, it's a permanent transformation, and the buildings that once housed bustling companies are now financial dead weight. These properties were financed with cheap debt when interest rates were at historic lows, often around 3%. Now, as those loans come due, owners are being forced to refinance at rates more than double what they paid before, 7%, 8%, even 9%. The math simply doesn't work. Buildings that barely broke even at 3% interest are now deep in the red, and owners are starting to walk away, handing the keys back to the banks. This slow-motion crisis is already accelerating. In 2024, Brookfield Asset Management, one of the world's largest real estate investors, defaulted on 2 major office towers in Los Angeles. Blackstone, the biggest name in commercial real estate, has faced a wave of redemption requests from investors desperate to get their money out. These aren't small-time landlords, they're the so-called smart money, and they're heading for the exits. When the biggest players start defaulting, it's a sign that the fundamentals have broken down. And with over $2 trillion in commercial mortgages coming due in 2025 and 2026, the wave of defaults is only just beginning. The impact of a real estate crash goes far beyond property owners and investors. Regional banks, which hold a huge share of commercial real estate loans, are dangerously exposed. When these loans go bad, banks are forced to write down billions in losses, wiping out their capital and triggering a cascade of failures. We've already seen warning shots. Silicon Valley Bank, Signature Bank, and First Republic all collapsed in 2023, even before a full-blown recession hit. If the economy turns south and defaults surge, dozens more regional banks could fail in rapid succession. The FDIC's insurance fund, which is supposed to protect depositors, is laughably inadequate for a crisis of this scale. If multiple large banks go under, the government will have no choice but to print money to cover deposits, risking a new wave of inflation that could destroy the value of the dollar. Meanwhile, the residential market is just as vulnerable. In overvalued cities like Austin, Phoenix, Boise, and parts of California and Florida, home prices could drop 40% or more if the bubble bursts. Homeowners who bought in the last few years could find themselves underwater, owing more on their mortgages than their homes are worth. That's not just a financial setback, it's a trap. People can't sell, can't move, and can't refinance. The ripple effects will hit everyone from construction workers to realtors to local governments that depend on property taxes. And unlike 2008, when the government could step in with massive bailouts, today's sky-high debt levels mean there's no cavalry coming to the rescue. The most dangerous part? Most Americans have no idea how exposed they really are. In 2008, the pain was concentrated among those who bought at the peak or took on risky subprime loans. In 2025, the exposure is everywhere. Millions have their wealth tied up in homes that could lose value overnight. Banks, pension funds, and even insurance companies are all on the hook for real estate losses. And with the government's hands tied by debt and inflation, there's no easy fix. The real estate bubble of 2025 isn't just bigger than 2008, it's more widespread, more interconnected, and more likely to trigger a chain reaction that could bring down the entire financial system. But the story doesn't end with real estate. The next domino is the bond market, the place investors have always turned for safety in times of crisis. This time, even that last refuge is starting to crumble. For generations, the bond market has been the ultimate safe haven, a place where investors could run when stocks and real estate turned volatile. In every major crash of the past century, from the Great Depression to the Great Recession, government bonds were the last line of defense, offering stability and a guarantee that no matter what, your money would be safe. But in 2025, that final refuge is collapsing under its own weight, and the consequences could be catastrophic. The numbers are staggering. The U.S. government now owes more than $36 trillion, a figure that's not just abstract, it's 125% of the entire country's GDP. That's the same debt-to-GDP ratio America had at the end of World War II, but with one crucial difference. Back then, the U.S. was the world's only major economy left standing, with decades of growth ahead. Today, America is competing with rising powers, aging demographics, and a global economy that's more fragile than ever. The bond market's problems start with simple math. The annual interest payment on federal debt has exploded past $1.2 trillion, making it the single largest line item in the federal budget, bigger than defense, bigger than Social Security. Every dollar spent on interest is a dollar that can't go to schools, infrastructure, or social programs. And as interest rates rise, the problem only gets worse. The government is trapped in a vicious cycle. It has to borrow more just to pay the interest on what it already owes, which means issuing even more bonds, which pushes rates higher, which makes the debt even harder to manage. This is the so-called doom loop, and it's a trap that has brought down entire countries in the past. But the real danger is that, for the first time in living memory, bonds are crashing alongside stocks and real estate. In 1929, when the stock market collapsed, bonds held their value. In 2008, as housing imploded, Treasury bonds soared as investors fled to safety. But in 2025, there's nowhere left to run. The bond market is buckling under the sheer volume of new debt, and investors are starting to panic. Reports claim that foreign buyers, once the backbone of demand for U.S. Treasuries, are pulling back, worried about America's ability to manage its finances. As demand dries up, the government is forced to offer higher and higher interest rates to attract buyers, which only makes the debt problem worse. This isn't just a theoretical risk. The warning signs are everywhere. The yield curve, a key indicator that has predicted every recession since 1950, has been inverted for a record 27 months, finally normalizing in late 2024. Historically, recessions follow within a year of this signal, and the clock is ticking. Meanwhile, the bond market is flashing red in other ways. Prices are falling, yields are spiking, and the value of supposedly safe government bonds is dropping at a pace not seen in decades. For investors who thought they were protected, the shock is just beginning. Pension funds, insurance companies, and retirees who loaded up on bonds for safety are now facing losses they never imagined possible. The consequences of a bond market crash go far beyond Wall Street. When the government can't borrow cheaply, it has to make impossible choices. It can slash spending, triggering a recession. It can raise taxes, choking off growth. Or it can print money to cover the gap, risking a new wave of inflation that destroys the value of the dollar. None of these options are good, and all of them lead to pain for ordinary Americans. The safety net that once protected the country from financial disaster is now full of holes, and the risks are growing by the day. What makes this moment even more dangerous is the interconnectedness of the entire financial system. Banks, corporations, and even foreign governments all rely on the U.S. bond market as the foundation of global finance. If confidence in treasuries collapses, the shock waves will be felt everywhere, from mortgage rates to credit cards to the value of the dollar itself. The entire system is built on trust, and that trust is starting to erode. Rumors suggest that some of the world's largest investors are quietly reducing their exposure, preparing for a scenario where the unthinkable happens, a full-blown crisis in the world's safest asset. So, for the first time in modern history, there is no safe haven left. Stocks are dangerously overvalued, real estate is teetering on the edge, and bonds, the last refuge, are now a source of risk, not safety. The everything bubble has left investors with nowhere to hide, and the consequences of a bond market collapse could be more severe than anything we've seen before. But the story doesn't end here. The next chapter reveals just how deeply the entire system is leveraged and why the coming crisis could be even more destructive than anyone expects. If you want to understand why the next crash could be the most devastating in history, you have to look beyond the headlines and dig into the hidden weaknesses that have been quietly building for years. The American financial system isn't just overvalued, it's dangerously fragile, propped up by record levels of leverage, unsustainable debt, and a concentration of wealth that leaves the entire economy exposed to even the smallest shock. This isn't just a story about numbers on a screen. It's about a system that's been stretched to its breaking point, where a single misstep could trigger a chain reaction that no one can control. Start with leverage, the silent accelerant that turns a downturn into a disaster. In 1929, margin debt, or money borrowed to buy stocks, reached record highs as everyone from Wall Street bankers to shoeshine boys tried to get rich quick. When the market turned, those debts became a death sentence, forcing investors to sell at any price and turning a correction into a full-blown collapse. Fast forward to 2025, and the leverage in the system is even more extreme, but it's also more hidden. It's not just margin accounts anymore. It's options trading by retail investors who are now using borrowed money and even credit cards to chase the next big win. It's corporations borrowing billions at low rates to buy back their own stock, inflating prices and making the market look healthier than it really is. It's the $600 trillion derivatives market, 10 times the size of the global economy, where complex bets on interest rates and credit risk could explode if conditions change even slightly. The leverage is everywhere, woven into the fabric of the financial system, and most people have no idea how exposed they really are. But leverage is only part of the story. The mountain of debt that's been built up over the past decade is staggering. Consumer debt is at all-time highs, with credit card balances exceeding $114 trillion and average interest rates north of 21%. Auto loans have ballooned with 84-month terms and record delinquencies. Student loans have reached $1.77 trillion, a burden so heavy that millions of young Americans have simply given up on ever paying it off. Corporate debt has quintupled since 2008 as companies gorged on cheap money to fund buybacks and acquisitions. And then there's the government, drowning in $36 trillion of debt with annual deficits that show no sign of slowing down. Every sector of the economy is maxed out, and there's no cushion left for when things go wrong. The final piece of the puzzle is inequality, a force that quietly amplifies every risk and makes the entire system more brittle. In 1929, the top 1% controlled about 25% of total income, a level of concentration that left the economy vulnerable when the wealthy stopped spending. Today, the numbers are even more extreme. The top 1% now controls 32% of all wealth, and the top 10% is responsible for 70% of consumer spending. If the wealthy pull back, the entire economy grinds to a halt. But it's not just about the rich. In 2025, 58% of American households are directly exposed to the stock market, either through direct investments or retirement accounts like 401ks and IRAs. That means when the market crashes, it's not just Wall Street that suffers. It's Main Street, retirees, and anyone who spent a lifetime saving for the future. There's no insulation, no buffer. The pain will be immediate and widespread. Even the safety nets that are supposed to protect ordinary Americans are looking dangerously thin. The FDIC, which insures bank deposits up to $250,000, has only about $125 billion in its fund, while insuring nearly $10 trillion in deposits. If multiple large banks fail at once, the fund would be wiped out in weeks, forcing the government to print money and risking a new wave of inflation. Social safety nets like unemployment insurance and food assistance are already stretched, and a surge in job losses would overwhelm the system. The government, already drowning in debt, would be forced to choose between cutting benefits or risking a fiscal crisis. All of these factors, leverage, debt, and inequality, combine to create a system that's more fragile than at any point in living memory. The warning signs are everywhere, but the risks are hidden in plain sight, ignored by those who believe that the old rules no longer apply. But history shows that when a system is this stretched, it only takes a small spark to set off a firestorm. And as the next section reveals, the warning lights are already flashing red, signaling that the time to prepare is running out. If you're waiting for a clear signal that the financial system is in danger, you don't have to look far. The warning signs aren't just subtle, they're blaring, impossible to ignore for anyone willing to look past the headlines. Every major indicator that has reliably predicted past recessions and crashes is now flashing red, and the pattern is eerily familiar to those who have studied history's greatest financial disasters. The difference this time is that the signals are all going off at once, across every sector, with a level of intensity that's never been seen before. Start with the yield curve, often called the market's most reliable recession predictor. For over 70 years, every time short-term interest rates have risen above long-term rates, a phenomenon known as an inverted yield curve, a recession has followed, with zero false alarms. In July 2022, the yield curve inverted and stayed that way for a record 27 months, only returning to normal in September 2024. Historical analysis shows that recessions typically begin 3 to 12 months after the curve normalizes, not while it's inverted. That puts us squarely in the danger zone right now, with the clock ticking toward a downturn that could begin at any moment. But the yield curve is just the start. Unemployment, which hit a historic low of 3.4% in early 2023, has started to creep upward, reaching 4.1% by October 2025. While that number might not sound alarming on its own, the direction of change is what matters. The Somm rule, developed by economist Claudia Somm, states that when the 3-month average unemployment rate rises half a percentage point above its 12-month low, a recession is already underway. As of late 2025, we're at or near that threshold, and history shows that once unemployment starts rising, it accelerates quickly as layoffs trigger more layoffs in a vicious cycle. Consumer debt is another flashing red light. Credit card balances have soared to an all-time high of $1.14 trillion, with average household balances at $6,800 and interest rates between 21% and 28%. Delinquencies, borrowers 90 days or more behind on payments, are at their highest levels since 2011. This matters because consumer spending drives nearly 70% of the U.S. economy. When people can't borrow more and are forced to cut back, the entire economy slows down. The same story is playing out in auto loans, where delinquencies have spiked to levels not seen since the 2008 crisis. 7.5% of auto loans are now 90 days or more past due, and the average monthly payment for a new car has climbed above $740. These aren't just numbers, they're signs that millions of Americans are stretched to the breaking point. The banking sector is already showing cracks. In 2023, Silicon Valley Bank, Signature Bank, and First Republic Bank all failed, marking some of the largest bank collapses in U.S. history. These failures happened before a recession even officially began. In early 2024, New York Community Bank teetered on the edge of collapse. These weren't isolated incidents. They were early warnings of deeper problems. Regional banks are especially vulnerable, holding massive amounts of commercial real estate loans that are now going bad as property values fall and refinancing becomes impossible at higher interest rates. The FDIC's insurance fund, which is supposed to backstop depositors, is woefully inadequate for a systemic crisis. If a wave of bank failures hits, the government will be forced to print money to cover deposits, risking a new surge of inflation. Insider selling is another red flag that can't be ignored. Corporate executives, people with the best view of their company's real financial health, are selling their own shares at a pace that historically precedes major market declines. Jeff Bezos has sold over $13 billion in Amazon stock. Mark Zuckerberg has cashed out billions from Meta, and NVIDIA executives have been offloading shares even as the stock hit new highs. When insiders are running for the exits, it's a sign that the people who know the most are preparing for trouble. Even the world's most successful investor, Warren Buffett, is sending a clear warning. Berkshire Hathaway's cash reserves have swelled to a record $325 billion, and Buffett has been quietly reducing his exposure to stocks, including trimming his massive Apple position. His favorite market indicator, the ratio of total stock market value to GDP, now sits at 185%, far above the level he once called dangerously overvalued. When Buffett is hoarding cash and can't find anything worth buying, it's a signal that the smart money is bracing for a storm. The timeline for crisis is also coming into focus. The normalization of the yield curve in September 2024 starts a countdown that, based on historical patterns, points to a recession window between December 2025 and September 2026. Commercial mortgage refinancing peaks during this period, with over $2 trillion in loans coming due at much higher rates. Credit card and auto loan defaults are already accelerating, and the next trigger could come from anywhere. A disappointing earnings report from a major tech company, a sudden bank failure, or a geopolitical shock. All these warning signs aren't just isolated data points, they're interconnected signals that the system is under extreme stress. The same patterns that preceded the crashes of 1929 and 2008 are present now, only more extreme and more widespread. The difference is that this time, the tools that once worked, rate cuts, bailouts, and money printing, are either exhausted or too dangerous to use. The red lights are flashing, the alarms are sounding, and the time to prepare is running out. But the real question is, what happens when the first domino falls? The next section reveals how a single shock could set off a cascade that brings the entire system to its knees. When a system is stretched to its breaking point, it doesn't take much to set off a chain reaction. The coming crash won't announce itself with a single, obvious event. Instead, it will begin with something that seems manageable. A disappointing earnings report from a tech giant, a larger-than-expected regional bank failure, a sudden escalation in a geopolitical conflict, or even a breakdown in debt ceiling negotiations. The trigger almost doesn't matter, because the system is so fragile that any shock can start the cascade. What matters is what happens next. As one failure triggers another, which triggers another, until the entire financial system is in freefall. Imagine this: NVIDIA, one of the Magnificent Seven stocks propping up the entire S&P 500, misses its earnings projections or issues weak forward guidance. In an instant, algorithmic trading systems, responsible for the majority of daily market volume, begin selling not just NVIDIA, but every tech stock tied to the AI narrative. NVIDIA's stock could drop 10 to 15% in a single day, and because it represents 7% of the S&P 500, that alone would drag the index down nearly a full percentage point. But the real damage comes from the psychological impact. If the AI story that's driven valuations starts to crack, investors will question all tech valuations. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all sell off in sympathy. Within days, the Magnificent Seven could be down 20 to 30%, taking the entire market down 6 to 9%. This is when the real panic begins. Margin calls are the accelerant that turns a decline into a crash. When investors buy stocks with borrowed money and those stocks decline, brokers demand additional collateral. If the investor can't provide cash, the broker sells the stocks to cover the loan. This forced selling drives prices lower, which triggers more margin calls, which forces more selling. In 1929, margin calls created a downward spiral that couldn't be stopped. In 2025, margin debt as a percentage of market value is at similar extremes. When the selling begins, it will be rapid and relentless. Institutional investors managing trillions in pension funds, endowments, and sovereign wealth funds have risk management rules that require them to sell when markets decline beyond certain thresholds. These aren't emotional decisions, they're automated processes. When stocks fall 20%, risk systems trigger selling to prevent further losses. This institutional selling adds to the downward pressure. Within the first month of the crash, stocks could easily be down 30 to 40% as retail panic selling, margin calls, and institutional risk management all drive prices lower simultaneously. The cascade doesn't stop with stocks. As investors flee equities, they typically run to bonds for safety. But in 2025, Treasury bonds are not safe. The government needs to issue trillions more to cover deficits and refinance maturing debt. If there's a flight to safety at the same time the government is flooding the market with new bonds, interest rates spike even higher. This creates a doom loop. Higher interest rates make the government's debt service costs higher, which requires more borrowing, which requires issuing more bonds, which drives rates higher. Countries caught in this doom loop typically end in either default or currency collapse through inflation. The bond market, once the world's safest asset, becomes a source of risk, not refuge. Meanwhile, the housing market freezes. Buyers disappear, and sellers are unwilling to accept lower prices. Homes sit on the market for months without offers. People who need to sell for job relocations or financial reasons start cutting prices. These price cuts establish new comps that drive all home values lower. Within 6 months, home prices could be down 20 to 30% from peak. Within a year, 40 to 50% declines are realistic in overvalued markets like Austin, Phoenix, Boise, and parts of California and Florida. Homeowners who bought in the last 3 years find themselves underwater, owing more on their mortgages than their homes are worth. Commercial real estate defaults accelerate as property owners realize they can't refinance maturing mortgages. They stop making payments and hand the keys to the lender. The lender, typically a regional bank, takes possession of a property worth 40 to 60% less than the loan amount. This is called a realized loss. When banks realize massive losses on commercial real estate loans, it wipes out their capital. Banks are required to maintain minimum capital ratios. When those ratios fall below regulatory thresholds, regulators close the bank. Bank failures create panic that spreads to banks that are actually solvent. Depositors see banks failing and rush to withdraw their money from any bank they perceive as risky. This creates a classic bank run. Even healthy banks don't have enough cash on hand to pay all depositors simultaneously because they've lent the money out or invested it in securities. When a bank run starts, the bank has to sell assets to raise cash. Selling assets at fire sale prices creates losses that can turn a healthy bank insolvent. The FDIC steps in to guarantee deposits, but the $125 billion insurance fund is inadequate for multiple large bank failures. The government has to print money to cover deposits, which starts the inflation process that destroys the currency. As the crash unfolds, unemployment surges. Companies facing declining revenues cut costs through layoffs. Tech companies that grew bloated during the boom start laying off 10 to 20% of their workforces. Finance companies heavily exposed to market declines cut staff. Consumer discretionary companies facing customers who can't spend close stores and eliminate positions. Within 3 months of the crash starting, unemployment could rise from 4% to 7 or 8%. Within 6 months, 10% is realistic. Within a year, 12 to 15% unemployment is likely as the cascading failures move through the economy. The Federal Reserve faces an impossible choice. They can cut interest rates and implement quantitative easing to try to stabilize markets. But this risks reigniting inflation before it's fully been tamed. Everyone remembers 2021 to 2023, when inflation hit 9% and destroyed purchasing power. If the Fed prints trillions again, the dollar will collapse and inflation will return even worse than before. Or they can let the crash play out, which means depression-level unemployment and a decade of economic stagnation. There is no middle path. The tools that worked in 2008 don't work in 2025 because they've already been overused and everyone understands the consequences. This is how the cascade unfolds. A single shock triggers a chain reaction that moves from stocks to bonds to real estate to banks to jobs, with each domino knocking over the next. The system is so interconnected, so leveraged and so fragile that once the process starts, it's almost impossible to stop. The only question is how deep the damage will go and how long it will take to recover. But as the dust settles, the aftermath will reveal just how much has changed and why the road back may be longer and harder than anyone expects. When the dust finally settles after the cascade, the world that emerges will look nothing like the one we knew before. In past crises, recovery was painful but possible. Markets rebounded, jobs returned, and the economy eventually found its footing. But this time, the scars will run deeper, and the path back to normalcy will be longer and more uncertain than most people can imagine. The reason is simple. The tools that once powered rapid recoveries are now either broken, exhausted, or too dangerous to use. The aftermath of the everything bubble will be defined not just by lost wealth, but by a fundamental shift in how Americans live, work, and plan for the future. For millions of Americans, the most immediate impact will be the destruction of retirement savings. In 2008, portfolios were battered, but most people who held on saw their balances recover within 5 years. This time, the story could be very different. If the market drops 60 to 70%, as some analysts warn, a lifetime of savings could vanish almost overnight. Someone who spent 30 years building a $600,000 nest egg could see it shrink to $200,000 or less with no guarantee of a rebound. For those already retired, the situation is even more dire. They'll be forced to sell assets at the bottom just to pay the bills, locking in losses they'll never recover. The psychological toll of watching decades of work evaporate will be profound, leading to a generation of Americans who feel betrayed by a system they were told would always protect them. The housing market will be another source of lasting pain. Homeowners who bought in the last few years, often at record prices and with minimal down payments, will find themselves underwater, owing more on their mortgages than their homes are worth. Many will be trapped, unable to sell or refinance, forced to ride out years of depressed values. The ripple effects will hit local governments, which rely on property taxes to fund schools, police, and basic services. As home values fall, tax revenues will collapse, forcing painful cuts just as communities need help the most. The dream of home ownership, once the cornerstone of the American middle class, will feel more like a burden than a blessing for millions. The job market will also be fundamentally altered. In the wake of the crash, companies will slash hiring, freeze wages, and lay off workers in droves. Young people graduating into this environment will face a brutal reality: few jobs, intense competition, and lower starting salaries that will haunt them for years. Studies of those who entered the workforce during the 2008 recession show they earned less over their entire careers compared to those who graduated just a few years earlier. The coming downturn will be even worse, with economic scarring that could last a generation. Small businesses, the backbone of local economies, will be decimated as consumer spending collapses and credit dries up. The survivors will be larger corporations with access to capital markets, leading to an economy that's even more dominated by giants and less friendly to innovation and entrepreneurship. Social safety nets will be stretched to the breaking point. As unemployment surges and tax revenues fall, the government will face impossible choices: cut benefits for the most vulnerable, or borrow even more and risk a fiscal crisis. Either way, millions will fall through the cracks. Programs like Social Security, Medicare, and unemployment insurance, already under strain, will be forced to do more with less. The result will be a humanitarian crisis layered on top of the economic one, as families struggle to afford basics like food, housing, and health care. The political consequences will be just as severe. History shows that economic collapse breeds instability, anger, and extremism. The 1930s saw the rise of radical movements across Europe, fueled by desperation and a sense of betrayal. The United States is not immune. As people lose jobs, homes, and hope, they'll look for someone to blame and for leaders who promise radical solutions. The political landscape will shift in unpredictable ways. with the potential for social unrest, polarization, and a loss of faith in institutions that once seemed unshakable. Perhaps the most sobering lesson comes from abroad. After Japan's stock market crashed in 1990, it took 34 years for prices to recover. An entire generation of Japanese investors never regained their lost wealth. The same fate could await Americans if the crash is deep enough and the recovery slow. Unlike in 2008, when the Federal Reserve could cut rates to zero and the government could borrow freely to stimulate the economy, those options are now off the table. Interest rates can't go much lower without reigniting inflation, and the government's debt load is already at historic highs. Printing more money risks destroying the dollar's value and triggering runaway inflation. The tools that once worked are now liabilities, and the margin for error is gone. In the aftermath of the everything bubble, the world will be forced to confront hard truths about debt, risk, and the limits of financial engineering. The era of easy money and ever-rising asset prices is over. Recovery will be slow, uneven, and painful, with no guarantee that things will ever return to the way they were. For those who survive, the lesson will be clear. The old rules no longer apply, and the future belongs to those who are prepared for a world where nothing can be taken for granted. The question now isn't just how to recover, but how to adapt, and whether we'll have the courage to face the new reality head-on.